And welcome everyone, and especially to our HLB community members. Thank you for joining this webinar. My name is Tanya and I will be your moderator this afternoon. Today we are presenting Do Your Clients Have a Plan When It Comes to Year-End Tax Time? With your presenters today, Tax Consultant Partner Peter Bembrick and Advisory Manager Warrick. Now without further ado, I'll hand over the presentation to Peter.
Thanks, Tanya. Thanks, everyone, for joining us. Good to speak to you again. We've got a fair few things to get through here. We're going to kick off with the budget, and there's a few other. We'll probably spend a fair bit of time on some other matters like trust, the ATO's trust changes. But before we get to that, it wasn't really that interesting a budget from a tax point of view. Obviously, it's a pre-election budget, so we're naturally the government had a few things to try and particularly short-term things like you'll be all probably pretty familiar with the no actual personal tax cuts. We've still got what they call their stage 3 cuts from a couple of years, three or four budgets ago, to come from 1 July 24. So nothing has been done with that, which would move some of the brackets, as you see on the slide there. Some of the main changes that were brought in, the $420 cost of living offset. So for those clients that are in the that were claiming the low and middle income tax offset, there's an extra $420 maximum amount, depending on their income levels, if they're eligible. Obviously, higher income earners weren't getting anything, and wouldn't get anything for this either. And that's for the 2022 year. So even though it's essentially a benefit, but won't be until they do their 22 tax returns. So you might find, as we've seen the last couple of years, some clients wanting to do their returns reasonably early to get these benefits if they think they'll do a refund, because it will increase their refund. This sort of offset, I'm sure most of you know, doesn't give a cash back, unlike refundable franking credits. But if they're tax payable, it certainly reduces the tax payable, and therefore if they've had withholding for salary wage earners or with withholding of people paying instalments, that was likely to give them some sort of a refund in a lot of cases. But no extension of the low middle income tax offset. So it was always a short-term measure. It hasn't been extended beyond this financial year, so that will go, as things stand. That will go from next year. Other things, again, much reported in the press, the reduction of 50% in the fuel excise. So I suppose the government is banking on a bit of goodwill being generated by cheaper fuel for 6 months. And of course, that would depend on a whole lot of other factors. Simply reducing the excise, then there's got all the ups and downs. So whether we see that we'll see some impact in fuel prices. I guess the question is how much, and that will go up to September 22. Obviously, beyond the election. Nothing, people would speculate on things like electric vehicles, no changes to treatment of electric vehicles in the budget. Just a couple of other things before we move on. So the $250 for pensioner welfare recipients, if you've got clients in that category, the changes to the pension, the drawdown rate. So some of these might be more relevant, particularly to your business clients, SME business clients. So again, we haven't got legislation for a lot of these, most of these things, so we just have to see what's actually happening. But so from 29th of March up until 30th of June 24, we've got an extra 20% deduction from things like training courses, so effectively like 120% deduction for external training courses, not internal or on-the-job training. Contractors' queries will obviously, devil's always in the detail, so the questions will be, how does that apply to something like contractors? You would expect that external training organisations are going to get quite a boost from this. There probably should be quite a bit in it for them, giving it 120% claim for the business for the cost of eligible training. But again, we've got to see a bit more detail on those rules. is a small business, so aggregated turnover less than 50 million is the cutoff. So hopefully you've got a lot of clients that could potentially benefit from that, as they have from various other small business concessions in the last couple of years. They'll need to claim, so there'll need to be claims in the 22 year, and then obviously then there's also claims in the 23 year as well, in the 20, so yes, so 23 and 24 tax returns. But again, there's a lot of detail we probably still need to see about that. And so a couple of, just the last slide, I think, on the budget, just a couple of other things. There's also a technology and investment boost, again, an SME benefit of an extra 20% deduction, for the policy being to try and help businesses up their technology, things like portable payment devices, cybersecurity, cloud-based subscriptions, again, depending on the type of business as to what relevance that has, but we'll give them 120% deduction on the costs of those things with an annual cap of $100,000 in the qualifying year. There's a few, again, more detail to be similar to the other provisions, but a lot of detail we're still to find out about that. So we'll see. Probably might not know that till after the election now as to how that will actually be implemented in practice. You must have everybody will have heard a reasonable amount of this. This certainly be aware of it. I'll probably listen myself to about half a dozen different webinars, and I will say that a few of the slides we've developed here, I've certainly used some of the slides, as well as reading materials ourselves and our own analysis. We've used some of the slides that we've gathered, so I won't claim that everything we've written on these slides is completely original, but I think most people have been hearing us saying similar things, and it comes down to individual client discussions, and we've had a lot of discussion internally about how we'll approach the ATO's guidance here. What do we say to clients? Just in the last 2 days, I've been through with one of my managers, let's say 3 client groups that have trusts in their structure that we've been having to think about how does this apply to them, and we'll be meeting with all 3 of those client groups in the next couple of days. So we'll have to have those live discussions about certainly definitely what we've just done. We've just done the 21 year. So what does that look like for the 21 year? What should they be considering doing for the 22 year? And then what risks have they got for the past? So it's obviously a very live issue. And so I'm just going to go through a few of the points, and may well be some questions. I'm happy to, we'll just go through, and probably I'll try and go through some of this and then yeah, but happy to cover a few questions as well. So this is probably the one I'll spend the most time on. I need to give Warrick a bit of time to just cover some other things as well. So to cover some of the basic principles here, why is this important? So so the consequence of this is if Section 100A, which again you're probably all aware, Section 100A is a very old provision, anti-avoidance provision. In a way, it's worse than Part 4A because that doesn't. There needs to be a purpose of tax avoidance, not a dominant purpose to start with, and also there's an unlimited time frame. Although there's a bit of a softening from 2014 when the ATO had released some very brief guidance previously. They're saying, well, unless it's really particularly serious or particularly concerned, there's a category of scenarios where we won't go back beyond 2014, but that's bad enough. The consequences are if the, and we'll explain a bit more, but if the beneficiary is deemed not to be presently entitled to income, a particular amount of trust income that's been allocated to them, then the trustee will be assessed on the distribution under Section 99A of the Tax Act. The trustee can claim franking credits, but unlike an individual beneficiary, the trustee can't claim a refund of excess franking credits under this scenario. So could certainly be in a worse position, and it's at the top rate of 47%. So generally, when a lot of the distributions they're going to be attacking will be at the lower rate beneficiaries. So there could certainly be quite an impact here if the ATO goes as far as people think they might. Okay, so some of the basic elements. So obviously you've got to have a beneficiary who's presently entitled to a share of income. if they're under a legal disability, so in most cases we're talking about minors, so this is not attacking minors. So if you're giving $416 to the under 18 beneficiaries, then that doesn't fall under 100A. The ATO is not interested in that. It's perfectly fine. If there's a testamentary trust in place, so a beneficiary, an under 18 beneficiary is receiving a larger amount and being taxed at normal individual rates, then again, they're not going to attack this. Question with whether testamentary trusts, there's really nothing, as far as we can see, there's nothing that would stop testamentary trusts with distributions to over 18 beneficiaries from being caught under this, because that would seem all the elements are available would apply, but certainly not the under 18 beneficiaries. So one of the really key points here is what they call a reimbursement agreement legislation. So, and as we'll touch on, that's an extremely broad term, so it doesn't have to be anything particularly formal or clearly documented, but if the ATO deems there to be a reimbursement agreement where someone other than the beneficiary receives benefits, then the ATO could choose to apply 100A with quite significant consequences. The ordinary family, there's a few exceptions to Section 100A, and ordinary family and commercial dealing is the one that most of us had thought meant that if you distributed within a family, and that's just a pretty standard scenario within members of a family, there was no clear guidance to suggest that wasn't okay. Now they're being a bit more explicit, and that's where, but having said that, what's an ordinary family or commercial dealing is still not really clearly defined under these more detailed, as if there's examples which help us to see what approaches the ATO will take, but there still isn't a really clear definition of what's a family or commercial, an ordinary family or commercial dealing. And as I say, they've got to be that it has to be a purpose of reducing a tax liability, or essentially there's got to be a tax purpose of some kind. Otherwise, they wouldn't fall foul of 100A. Okay, so where it doesn't apply, so where we're going to be okay here is some of the same sort of scenarios. Yes, we've got distributions. We do have the beneficiaries over 18. There may be a reimbursement agreement. Or either there's no reimbursement agreement, or there's the ordinary family. If something is considered to be an ordinary family or commercial dealing, which again is not completely explicit what that will mean, but if the ATO is prepared to accept that this does fall within that exception, then you'll still be okay. But it's going to depend very much on each situation, which, in talking to clients about this, it's still not going to be very easy for them to explain to them, and so we're going to have those conversations. So I'll try not to get bogged down too much in the detail of some of these points, but again, just I mentioned earlier, agreement is very widely defined. So any agreement, arrangement, or understanding. So it certainly doesn't have to be written. Formal or informal, express or implied, doesn't even necessarily need to be enforceable as such, although there does need to be some sort of agreement, and it must exist before the distribution is made. So before, say, in June 2022, you're going to make the trustee will pass a resolution to make beneficiaries presently entitled to the income. That agreement or understanding, whatever form it takes, would need to be in place before at that time, essentially. So, okay, so now we get to what do all these new ATO guidelines mean? They're becoming, as you'll see, I'm going to talk later about the ATO's approach to professional firm income. We've done a presentation to the HLB community on this when the draft came out maybe a year or so ago. So I'm going to cover some of those same points now that we have the final version of that practical compliance guide. There they do a more probably easy to understand traffic light risk approach of green, amber, and red. Now, for some reason that no one can really understand, we've got slightly different colors here. So red's obviously clearly not where you want to be. That's the high risk scenario. Blue is, they've introduced blue as a medium risk. We're saying, whereas a red, the ATO will review and may well proceed to audit. So it's not that hard to fall into a red high risk scenario. Blue, the ATO wants to understand those arrangements better, whatever that means, but they'll so they may or may not have a closer look, or they might, if there is if they have some cause to look at your client's group, they may be looking at those blue scenarios. And there are certain sort of features that where funds are being retained in the trust, and the PCG goes through that. But I won't go through a couple of examples briefly, but we could have a more detailed discussion about the specifics. But obviously, again, I don't want to get bogged down too much. But the PCG 2022 D1 is where all of this detail really is. The green ones are the low risk, so that's where you want to. Sorry about that. So what that one thing that's worth noting here is that mixing effectively splitting income with a spouse, or having the spouses can mix their own their funds together, and the ATO doesn't see that as being just because one of a couple, because one person might have been the way known who earned that income through the trust, through maybe running a business or running it as an investment vehicle. The fact that their spouse then receives some of that income isn't necessarily a problem. Now, it might cause issues if it's professional firm income being run through a family trust, which is under that other PCG we'll touch on at the end, towards the end of the presentation. But for these purposes, mum and dad receiving distributions is perfectly fine. It's when you start getting into the other, which we'll touch on in a minute, the other family members, the adult the adult children, that sort of thing, or corporate beneficiaries for that matter. And then so how that, although with corporate beneficiaries, they talk a bit about that in here, but we've already got Division 7A to deal with. So probably in most cases, what you're doing to satisfy Div 7A is still going to work more broadly. That's still going to work. So it's probably less. You've got the same issues that you already have under Division 7A, but certainly between different individuals or maybe one trust to another trust, some of the really high risk scenarios that they see is, for example, the red trust distributing to a loss, red in the red category, distributing one trust distributing to another trust with losses, or to foreign residents, or anything where there would be lower tax paid, and it seems a bit contrived. That's the sort of thing the ATO is really after, but they're going to catch what you might consider to be more of an ordinary arrangement in amongst those high risk arrangements. And there's always a rider with the green and the white, for that matter, that if there's factors that would pull something into a red or blue zone category, then it pulls it out of a green, but a more standard scenario should be green. And this is what I mentioned earlier about the 1 July 2014, because the ATO had some very brief guidance. They had something on their website which provided very broad and quite vague guidance on this. And they'll say, well, if you've from before 1 July, anything that was a pre-1 July 24 arrangement, they're not going to go back too much on that. And from 1 July up until 1 July 22, if you've got an arrangement that under the ATO's previous guidance seemed okay and seemed more favourable, they'll honour that. But the reality is that guidance was so vague, it's hard to see how that helps us. So, but certainly from this 1 July 22 onwards, for going forward, we're going to have to be really careful. And I think that's a lot of this is about, well, they might look at the risk of the past. A lot of this is, most commentators and most people tend to think, a lot of this is going to be about changing people's behaviour going forward. And that's probably the main agenda here. And while there is still consultation going on till I think the 29th is the revised date for consultation. I know the professional bodies and others are all getting their submissions finalised to get into the ATO. We'll have to see what comes out of that consultation process. But it's sort of hard to see. They may soften their retrospective approach, or they might not explicitly, but the reality might be that they might not go too hard in terms of retrospective application, but it's probably likely that they will. It's hard to see the approach being to soften too much going forward, which seems to be a big agenda here. So I think that's a key slide there. The risk, and you really need to do to have a closer look at these documents to see the scenarios that are described as particularly high and medium risk. Just to highlight, one of the documents is the Taxpayer Alert, and I think you'll see with other taxpayer alerts are never good. Never, if you potentially fall under a taxpayer alert, that's never going to be a good thing. It's something that the ATO obviously sees as an area of concern. So they bring out something which is sometimes followed up with a rule, with some sort of determinational ruling. But in this case, it seems to be really, they've already got the rule, the practical compliance guide and the draft practical compliance guide and the draft ruling, which go through a lot of what they're not happy with. But then they've also decided to add this taxpayer alert, and not as a draft, but as a final, to highlight the things that they're particularly not happy with, which is, as I alluded to, the parents distributing to adult children. So if it's mum and dad distributing to their adult children, and that's a couple of the examples that I've just been talking about with some of our clients, and and you look at what the situation and say, well, are they the parents more or less keeping control of the money, or the trust keeping control of the money, but distributions are being allocated to individual, so who are over 18 and don't earn much themselves, and we would have, like most of us, would have thought that was still could be done within a family without too much problem. But obviously the ATO wants to have a closer look at those arrangements, and again, that's where what risks have we got in the past is an issue, and what can we really do going forward. What do we tell clients that they're able to do going forward, without paying up too much risk? And what the ATO says in the taxpayer alert, as they usually do with these alerts, they say, well, here's the scenario we're looking at, and they usually give a laundry list of potential provisions that they could apply. So again, in this case, it's Section 100A is at the top of the list. That's the thing we're mainly focusing on here, and that's probably the worst one because of this unlimited time period, and they can go back. Part 4A is also still, they also note that Part 4A could possibly apply as well, or as an alternative. They may also just determine that the distributions of children are a sham. They weren't validly made, and simply, and sort of going along with that is the idea that the parents are the real beneficiaries. So they may simply say, well, the parents really were, they just were simply a tax the parents, and that might actually be preferable to, in some cases, than having the trustee taxed. But that the ATO doesn't say exactly which one they would do, but it would, obviously they're saying these are, in any particular scenario, these are all the things they could look at. And so it's but seeing them putting them on notice, and I mean, the focus seems to be on the adult children. That's certainly what a lot of the discussion has been about, but could also, you've also got the retiree in terms of other individuals in the family group. The other one you see a lot is the self-funded retiree parent. So I know of at least one group that has distributed to basically both mother-in-laws within the family, essentially have received distributions from the trust, and so you've, I guess, got a question in those cases: are the mother-in-laws actually expecting to get any money from that? They might have the trust. They might expect the trust to pay the extra tax, but are they going to get the rest of the money? But probably that's definitely an area of risk that we need to be conscious of. But when it comes to the adult children, it may be managed to quite well. Could well easily be it could well easily be that they want them to get the money. They'll, you pay money for house deposit. That's obviously a common one in Sydney, especially these days. there might have been a lot that they spent since they turned 18. What the ATO is very clear on is that they don't accept the argument that they've been spending money for the children since they were very young. They say anything under 18 while they're a child, whether it's at school, they expect the parents really to be paying those costs anyway. That's part of raising a child, as the view. So it's not really accepted that they would be the trust would be. I know sometimes I've seen it where people actually keep track of, particularly not everything, but maybe even school fees. So they get the trust to pay those school fees and record them against a loan account, so that beneficiary distributions cannot be offset against those costs. But the ATO is definitely suggesting in these guidance that they're not going to be happy with that. And but if they're paying university fees, if they're paying other things that are for them, or they're even putting money aside for them, then that's the sort of thing that would be accepted. And all these examples are taken from the PCG, so I'll go through them very quickly. So this is where, as I said earlier, spouse mixing funds with someone mixing funds with their spouse into a joint bank account or to joint family. They say, well, as a couple, you pool your funds generally, so that's perfectly normal, no issue with that. Same with paying for costs for dependents. And so it may be that you have someone who's over 18 who's a dependent. I certainly know families that where their adult children they would say are probably dependents well into their 20s and their even late 20s, but it's whether they actually count them as dependents at that stage, but certainly when they're just because they turn 18 may not be arguably the cutoff, but it's certainly it's the HO is looking very closely at anything like that. But certainly that's where the ordinary family dealing makes sense, and they would generally say, if it's a very vanilla scenario, green seems okay. Just an example too quickly. So if you've got a trust running a business here, so if there are if the trustee retains funds as working capital and lends on question, particularly with an individual, is it how common is it that a trust would lend to an individual on or the trust would lend on Division 7A terms? We think that when they talk about that, it's probably more like that it should be more, they're using Division 7A as a proxy for commercial terms, that if you've got interest-free loans, particularly your individuals, so the individuals letting the trust use the funds interest-free, because that's the point. And so with a company, you've got to think about Division 7A. So then clearly it makes sense with a company that you might be applying Div 7A. Individuals, not normally the case, but the main point here is more about that it should be commercial. Otherwise, you're letting the trust use the funds interest-free. But so depending on the specific facts, that can be acceptable. But again, you've got to probably look at the specifics there and probably go through all the examples that the ATO gives a bit more closely. This one is pretty. It's pretty clear. You'd be aware of this. The washing machine arrangement that's been discussed with Division 7A and UPEs. It goes back quite a while with the ATO guidance, and I didn't think really people were doing this anymore because from the divisions, just in terms of the ATO's guidance on UPEs and Division 7A, I didn't think that really worked. This really worked. They're certainly making it very clear that anything like this, where it's common to have the trust owning the shares in the corporate beneficiary, so you may have to pay dividends back to from the company back to the trust, because that's the only place they can go. But it may be that if the trust then distributes that money, that dividend income out to the individual beneficiaries, and that's where the money entitlements go, then there may not be an issue. But if they cycle it back year on year, so it never escapes the cycle, then that's definitely not going to work. The ATO's made saying that's clearly a red arrangement, because that's there's only the 30% tax being paid here, and that actually is the you would have read probably about the Guardian case, and it's curious. It is curious in a way that the Guardian was a case that the ATO recently lost, and it's under appeal. So they might still win that ultimately, but that had that sort of scenario. But the discussion in the case was around the federal court was around the ordinary family commercial dealing and what the motivation behind the arrangement was, and the specific under those facts, there were very good records kept, and that's we'll get to touch on the idea that really record keeping as to why you're doing certain things is going to be quite key, and that taxpayer and Guardian had very good records and was a very credible witness, and the court accepted what he was saying, and that what he was doing was reasonable, but they actually did have facts on those lines, but there was obviously more to it. But in most cases, this is not an approach you'd be looking to take. So here's a good example that's again that is accepted as a green zone. So we've got Danny, who's there, a daughter at university. Trust is running a news agency business, so she does receive some money which goes towards paying her uni fees. So she's clearly getting the benefit from it. The rest of it goes 50-50 to the parents. They leave the money in the trust for working capital in the business. But I guess it would be on the balance sheet. The expectation would be that they could call in their entitlement. They are controlling the trust. It's not like putting it into, if they put $200,000 into, or $150,000 into the daughter's name, and it was questioned whether she would ever draw on it or was really ever intended to draw on it. That would be a different story. But in this is a fairly simple example that's given as to where the ATO would accept what's being done without anything more complicated. Okay, and this is where, again, just to example 5, which is again from the ATO, was they're saying that, so they buy, Lisa and Matthew buy a property for their daughter Kate, or they give the money to from the family trust to help with the deposit for her property, and so the ATO in their explanation and this is that, well, if that's all that happens, it's just an ordinary gift, and perhaps if it's a one-off, they might accept that, because she's certainly getting the benefit from it. But if and that's actually I suppose the parents taking the distributions and giving it to their daughter. So probably the gifting back from children to parents is perhaps more likely to be questioned, and this is the 2 points at the bottom of the slide, is that things can go either way. So if Kate gifts, the last dot point, if Kate gifts money back, receives distributions and gives money back to Lisa and Matt, to her parents, then particularly if she does it regularly, that might be a questionable, that she ever was really intended to get the money. On the same token, if Kate could have received the distribution, but the parents are retired, so they take the trust distributions, but then they give their daughter the money. And again, particularly if they do it consistently, you've got to question, the ATO would question whether that's actually valid, what they're doing there. So very fact specific this. So I think probably just, so now I get to turn it over to Warrick. I've done plenty of talking for the moment. So Warrick, over to you.
Thanks, Pete, and thanks everyone for having me today. I'm Warrick Oakes. I sit within the advisory practice here at HLB Mann Judd, specialise in mergers, acquisitions and transactions. I just thought I'd spend a couple of minutes talking through what we're seeing in the marketplace, and then how this ties through to how you can start having these discussions with your clients, particularly at tax time. So very importantly, we're sort of just coming out the back end of COVID, which has been an incredibly stressful time for most of the clients we've been engaging with of late. A lot of them have had significant growth to their businesses, so their businesses are worth a huge amount of money, particularly more than what they had going into COVID. So some of them are definitely looking at exiting in the short term. What this also does allow is obviously for anyone looking to buy a business, because there is a certain amount of fatigue out there. We are expecting that we're going to have difficult trading conditions for the next 1, 2 or 3 years. Where obviously we've got some issues with labour shortages, disrupted supply chains, and ever increasing costs, as well as inflation and increasing interest rates and so on. So what we basically try to do here as a firm is use the opportunity of going in front of our clients to talk to them about their tax planning and issues and so on, but then also just have a wider strategic discussion in relation to their future plans. The best way to maximize values for your clients, if they are looking to transact, either by a buy or a sell, is to be prepared, because the worst thing that can happen is if they were, for example, to receive a sort of unexpected offer, we find that offers in that nature are generally lower than what would happen if it was planned out, strategically motivated, and then also just sort of everyone works toward that goal. As HLB community members, there's a great opportunity here for you guys to get involved. We often find, businesses of a certain size require a bit of assistance to be sale ready, or from a buy side transaction side, running due diligence procedures and so on. That's basically all I really wanted to discuss with you guys today. There is another slide following this one, which basically just is a brief introduction to client solutions. We obviously have a number of services which won't be of benefit to you guys. More than happy to field any calls. If you have any questions in relation to things like that, here's the slide, just going through a few more of the more complex matters which we deal with. Thanks everyone, over back to Peter.
Yeah, no, thanks Warrick. So yes, we wanted to so we wanted to just put a couple more things in there just to break up the tax discussion, and we'll so as I said earlier, we'll touch on a couple of other things. One idea was, is there anything coming out of the election? But we didn't think there's anything particularly that we want to say, or that anyone really wants to. It's it will be, who knows what will happen out of the election, but we'll whoever wins the election, I mean, we've got these perennial issues that you would all be familiar with, and that we've already talked about, the trusts and the Section 100A, and so it's planning. If you've got trusts in the structure, obviously doing the planning is important, and it's going to be more important than ever to be having those discussions with your clients, and certainly leading up to year end, as to how to manage the income going through their trusts. Some of the other issues that you'd all be dealing with regularly would obviously be with CGT. I think I've seen a lot of with clients that have investments. There's obviously been a lot of volatility in the market through the COVID period, all the highs and lows, so, and everything else that's going on in the world. So if subject to making subject to the investment decisions that clients want to make, if there are clients that do have capital losses, or that do have made capital gains, want to realise capital losses, or there's gains to be realised that they can offset against losses that they already have, they're all just doing a bit of planning on those lines, if it makes sense from an investment point of view, or they may be just moving assets internally, but you plan to do it at a time when it makes sense from a CGT perspective. Really basic tax planning like super deductions, donations, anything else that if there is a bit of income bringing forward to get from a time benefit, and also obviously the if there's a bit of income there, getting the income into that year, and particularly if there's bigger trust distributions going to certain individuals, then looking at things like maybe maximising their super or other deductions to help reduce the impact of that. Obviously work from home is still there, still a thing, probably certainly has been in the current financial year, and probably is still happening, so maximising those sort of deductions and any other work deductions, but with the usual substantiation requirements. On the income side, obviously deferring certain income if it gets down to the fine tuning of if you can defer business income into the following year, that might be useful. And for small businesses, the prepayment concession of up to 12 months can still be useful as well. Then you've got all the things like temporary full expensing, those budget measures that came in. So the temporary full expensing is still there for depreciating assets. Loss carryback rules are still going, and obviously there's a bit of planning around how they can be used, if applicable. I think follows a bit from what Warrick was saying. We're still seeing quite a bit of activity around business sales and restructures. So I probably tend to see just as many restructures or restructure opportunities as actual sales. But there's, again, you'd be if you've got seeing those things happening, or if there are opportunities, then anything to do with the small business CGT concessions. Seeing a lot of activity around the use of those concessions this year, and it's definitely when you can get them, and that sometimes involves getting a private ruling. I've seen a couple of those recently too, where you need a ruling from the ATO to confirm a particular position, but it just makes such a difference if you can get it. So that again requires quite a bit of planning, and of course Division 7A, and making sure that not only covering currently Division 7A issues, but making sure that if there are prior year loans, that those minimum repayments are made, and if there's things like dividends that need to be paid, or other cash needs to be made, payments that need to be cash that needs to be made available in order to fund those repayments, can all be, if clients have a lot of Division 7A issues, that can really snowball. So making sure that they keep that under control, and keep that. Make sure that the Division 7A issue is planned, as well as all the rest of their planning. So,
you often find that a headline price which is close or a little bit over the over what the concession amount is, actually becomes quite a good negotiable position, because you can actually accept less and receive a lot more in terms of your back pocket. So we do find, a number of transactions, we'll run a scenario analysis, and often you find that it is actually far better to accept a lower headline price, which is obviously better. Generally, the buyer is more than happy to do that, and then you come up with other structures in ways you can get that value up. So whether it's through a salary later on, or rental agreement or something like that. So definitely ways in which you can work things through, but certainly a great concession to take advantage of.
Yeah, absolutely. And you're right, Warrick. There's a couple of points there around certainly the $6 million test. As you say, if you can if getting under that $6 million can make a difference. And I've seen that recently with one where we were assisting with, and there was there's a number of issues around that, around whether who's grouped in the structure, and whether it's a share or a business or an asset sale can obviously make a difference to how the grouping rules apply there. And that was in that transaction, that was one of the considerations to take a slightly lower price. And in the end, it became more around doing the calculations and probably just scraped under, but that definitely would have been a consideration. So yeah, all that, and that's what the planning is important. Yeah, and definitely. And one recent discussion I had with one of the HLB community members was around medical practices, for example, and I know that. I think everybody is quite familiar with the idea that if someone has a medical practice company, they pretty much have to pay all the income through. The ATO's got very old tax rulings where they make their position clear on that they see that you can have a medical practice company, but the doctor needs to essentially receive all the income directly or indirectly. So without even, obviously they would probably pass the PSI rules, but still should get all that income. Now, if they've got a number of other we've seen situations where a number of doctors, say specialists, were getting together and running a larger practice and looking to expand that and bring in other specialists into the practice, and it seems that is something that can be done, and so then that puts them in a similar situation to an accounting firm or a law firm or an architectural firm, where you've got a number of professionals in business together, and they would have to consider. I would think they have to consider these rules. So any profession probably will. And again, you have people who, I guess, range from different views, ranging from this is the ATO is being too tough, and they're too, well, why should professionals get them, and why should the ATO is being too tough, and why shouldn't professionals be able to do the same thing that other business owners can do in terms of splitting income essentially, or having income being taxed at a sort of a corporate level, and handled in a whatever structural way that you choose. Other views would be, well, you should, salary and wage earners split their income. So why should partners in accounting firms or law firms be able to do it? So, but it's in any case, if you've got these structures, these are the sort of rules you need to apply. So just to briefly recap on the old rules. So recall that the ATO had these three benchmarks up until 2017 when they suspended them. They decided that they weren't quite doing the job that they were originally intended for. So the ATO wanted to do a rethink, which took them about 4 years to release something else. In the meantime, we were in limbo, but we had these guidelines to apply in the meantime. So you had 3 tests, and you could satisfy any one of them, being the remuneration was benchmarked to the lowest paid member of the upper quartile of the firm was one way to sort of described, but you basically have to look at a very highly paid professional staff member who could be benchmarked against. If that would be one approach. If at least 50% of the firm income was going to they call the IPP, so and so it was the firm income being, when we say that, so when I say the firm income going to the IPP and the associated entities, so basically their profit share, so at least 50% of their profit share was ultimately accessible to the partner themselves. Then that was one benchmark, and we'll touch on that. That feeds into the new tests, but unfortunately you have to apply more than just one test under the new rules. Or if there was an effective tax rate of at least 30% across all the entities, then that was another one. So they picked up these same concepts but applied them in a much more strict way. But before they do that, the ATO has also in their practical compliance guide, this is PCG 2021-4, which was released in final late last year. They have put in what they call these 2 gateways. And it's, I suppose the first one is more along the lines of it's just got to be commercial. The first one is they've got to be actual commercial benefits. It's got to be documented, not an overly complex structure, and reflecting the economic substance. So it's a bit of a the whole arrangement has to stack up. And I think we've a feeling is that a lot of firms will be able to, professional firms will be able to show that it is actually it is a valid structure. It's been properly set up. The gateway 2 might be a bit harder. And the idea of these gateways is that if you breach some of these, then they actually don't even want you to go any further. They want to say, well, you may have an issue. They'd like you to talk to them and have a closer look at the situation and see whether the way income is being distributed to the partners or the practitioners is appropriate. So again, this is a sort of a firm level review, and then we get down to tests that apply at each individual level. So if something's subject to a taxpayer alert, I mean that's a big one because that could be very broad. If you're financing non-arm's length transactions, that could be one where if exploiting accounting and tax differences. I mean, I don't know, haven't really seen a lot of situations where these would apply, but there's been certain assignments of the partnership interest. Now, I know for firms, there's certainly been firms like some of the big 4 firms that have done Everett assignments. You're familiar with that idea back to Everett's case, which is way back. And it's something that is accepted, that a portion goes back to partnership structures where a certain portion of the partnership interest could be assigned to a related entity, and that could be done validly. It wasn't like if it was done in a certain way. I've heard of things like interest being allocated to a self-managed super fund, and that might cause that obviously would cause more concerns. But if done in the right way, something like a net assignment, from what I understand, can still be done. But there are various discussions around what they believe might breach these gateways. The last one is probably of a bit of concern. The multiple classes of shares for non-equity partners. So there's a particularly larger firms. There is a you have if it's you have an equity and a non-equity partner. So someone might be someone that they receive a fixed profit share. They're not an equity partner, and but people can have levels of equity. So just because it's sort of someone will go from having no equity to having a small percentage of equity, and that can increase over time. So the ATO pretty much draws a line: you've either got equity or you don't. And their view is if you don't have equity, then you shouldn't be able to. They shouldn't have multiple classes of shares being issued, which is sometimes what can allow say distributions to go to, say, a family trust, and as opposed to an individual who simply receives a fixed share, and therefore that goes to them, all to them personally. So, again, there's probably detail of when, but it's probably we'll have to see, I guess, how that these are all things that can sort of pull you out of. You might have a valid structure, but some of these areas can. Elements can pull you out of even applying the ATO test. So time will tell exactly how the ATO is going to apply this, but they're giving themselves more weapons in their arsenal, I suppose. So perhaps so this is where, again, I mentioned earlier on, the traffic light zone is something that really conscious we're getting close to time here. So this particular slide was actually taken from the ATO presentation, so that there was a good in the PCG there are two tables, and this combines the two onto one slide. So I thought this shows well how the different factors apply, and so broadly speaking, you come up with a ranking. You want to be green, so you want to have no more than a 7. You have to apply. The partner has to apply the first two factors, 1 and 2. Number 3 is optional. So the way I see it is, in analysing this, is that just applying 1 and 2, you need to be a 7 to get to green. So that's probably the first aim, and then in worst cases you may get to a moderate, but you want to try and be a 7 if possible. Then whether you apply the third one, which is again a benchmarking, but that would have to be benchmarking against sort of someone who's providing an equivalent function. So it's almost like benchmarking against another professional, or someone else as a partner in an equivalent role in another firm. That's maybe more difficult, but I question whether that's really in most cases going to be necessary. So if we just stick with the first two, these little coloured lines that I've put onto the PDF, onto the slide there, was where I've looked at how you would get to a 7, and depending on individual circumstances, we've done a little bit of, we're starting to do a little bit of Excel modelling to see how different client scenarios might apply to it. But so the purple lines there where somebody has scores of 4 on the first one, so they've put 4 more greater than or equal to 50% of their profit share into their own personal hands. You recall that was one of its factors under the old rules. But if you do that one, then to be green, you're going to have also pay more than greater than or equal to 30% tax rate across what they call effective tax rate across the whole group. And so that, for some people, that combination will be achievable, and so that's effectively combining two of the ATO's old factors. In the old rules, you only have to give one of them, but in this case, you have to give a combination of both of those. So if there was a distribution of income that was going to put the rates below 30%, then you'd need to make sure that the total effective tax rate was at least 30% in order to get there. alternatively, the grey one has another 3 and 4 combo the other way, so that would require more than 60%, and not be greater than equal to, but greater than 60% to be returned in the hands of the person, the partner themselves, and that would allow them to pay taxes probably if someone on a lower level of profit entitlement or a lower profit, perhaps a less profitable firm, or they might have a low profit year, but they'll that allows the effective tax rate to be less than 30% as long as it stays above 25. So there might be a bit more scope for some tax planning there, although if that planning involves distribution to individuals, then Section 100A might make a lot of that bit redundant anyway, but you could still got the corporate beneficiaries that might help keep the tax rate down a bit. So that's the sort of combination that we see could also work. Again, as long as you're only going to get to a 7, and the blue ones were sort of scenarios where I thought, well, if someone's got if they were spreading income amongst their family, and this was probably before the Section 100A guidance came out, we had these thoughts. If someone was spreading income amongst their family and they were they were less than 50% to the actual partner themselves, then that would make them a 5 at the first, which makes it very hard to get to a 7. You have to pay at least have an effective tax rate across the group of more than 35%, which is, if they've currently been paying less than that, that's not great, but that's how you get to a 7. Otherwise, they accept they're a 5 and a 3, and they just have to accept a moderate risk. Which, what does all that mean? It just means that the ATO may take a closer look at their situation, but we don't know how the ATO is going to approach this or resource this at the moment. And if they do pay, so I'm conscious that we are a bit over time, so I'll try and wrap this up. Just to finish off that thought, so if we do, if they do end up with a 9, which would be say a 5 and a 4, that would be certainly, you don't want to be red. I think in all these things you don't want to be a high risk. So what we were seeing there is that a combination of something like get to an 11. So might be a 5, a 3, and then a 3 or something. So there's a couple of different scenarios where you might get to an 11 to get you back from a red. From a red to a like you might have to be 2, so you might have to be a 5, a 3, and a 2, something like that. So there's again, it's looking at those different scenarios. This is what the ATO has put out there. So and that applies from 1 July 22. So it's the 2023 tax year is the first time you have to consider that. But it's worth starting to look at, for your clients that are affected, it's worth starting to look at this now. And at least when you're doing their 22 work, and even though it doesn't have to apply, there might be decisions they can make now which can help assess their risk. Really, that's just a summary of some of the points that I was going through. Is that a low risk structure, the key features of a low risk structure are that the professionals taxed on more than 50% of their profit share, directly or indirectly. So they could receive dividends into a family trust, which then distributes out to the partner, for example. As long as that gets to them individually, that's fine. And as I said, having more than the effective tax rate more than 30%, they're the main ones. There's a couple. We'll send these slides. There's a couple of their other things to look at, but probably the first 2 are the main points. If you can get those 2, you're more likely to be low risk. So we've covered quite a bit there.